I think many people have noticed over the last couple of weeks that we started the show one way and then started it the other the next week, and many people have just completely changed what they think about the world on thin air, on very little. And it's because Treasury markets have been really whippy. Yields up 30 basis points, yields down 20 basis points, and nothing much has changed. What explains that, Mike?
Yeah, I mean, part of it is the fact that we seem to be at this inflection point in the economy, in the rate cycle, in the central bank cycle, right? And that creates a lot of uncertainty from day to day as the economic data comes out, right? The Fed is very data dependent here, right? Remember, there's a lot of FOMC members who think we should be raising rates over the next couple of years, right? So it's very data dependent, but I think the Treasury positioning and the general duration positioning has been really volatile. When rates rally, people have been panicking and buying duration, right? And chasing them further down, and then when rates start selling off, people get more optimistic on the economy and they try to sell them. So I think the positioning has been getting whipsawed.
What do you think, George?
Yeah, I think there's a directional trade that's been going on, and a lot of it is due to positioning. I think there had been some sort of short-term effects where people have gotten positioning for rates to go back up, and when they go back down, they have to cover some of those shorts, and that's actually exacerbated some of this. But I think it's just the uncertainty within the marketplace. Nobody knows what to expect from a trade deal perspective, where we're going to go next, and so I don't think you should be positioning for those short-term moves. You have to be positioning for the longer term.
What do you think holds the keys to a more sustainable move higher in Treasury yield? What holds the keys to that? Is it the Fed? Is it the trade story? Is it Europe? What is it?
I think it's more the Fed than a trade story right now. I think the Fed starts backing off, and you saw this, I think, a little bit, very little bit, last week when the Fed talked, right? They gave sort of the dovish action of lower rates, and they kind of gave a little less dovish on the verbiage around that. The first time they did that, the markets reacted very vigorously, and they haven't yet. So if they kind of pull back on that, you could start seeing rates potentially come back.
A lot of people might think it's the trade story. I mean, Bloomberg in the last couple of moments have broken this story about the White House weighing limits on portfolio flows into China. Nobody knows what to do with that. It feels like a very early preliminary conversation, but still, you've got to think about these things. What on earth do you do?
Yeah, so I mean, clearly the trade thing is volatile, and it's going to be, right? We don't think there's any big resolution that's going to come anytime in the next few quarters. So I think people who are expecting that are going to be disappointed. This is just, today's announcement is just another example of the tit-for-tat negotiating process here. But generally speaking, I think if the Fed starts pulling back on its dovishness and says, all right, we're going to do one more hike and we're done, and some of the hawks start to win sway and the data gets better.
Well, Mike, let's be clear here. That feels like where it's going at the moment. We've had Bullard, Evans earlier this week talking about perhaps we go into wait-and-see mode.
That's a curve flattener, right? So what that means is the front end, which is still pricing in several more cuts, pushes back up, but I don't think that means the back end of the curve elevates, right? The back end of the curve is going to continue to be weighed down by these big global flows. And I look at our yield sometimes, our 10-year Treasury at 170, and sometimes I wonder why it has a one handle, why it doesn't have a zero handle. When you look at the yields in the rest of the world, sometimes they have to look at it twice, say, oh yeah, it still is in the ones, not in the zeros, right? And it feels like the global flows are going to continue to weigh on the back end of our market and keep a lid on those rates.